All right, welcome everyone to the week 4 of our Intro to Finance class. Before we get started, a few logistics and about the feedback I got from over the week, from your emails, and also from the office hour on Friday night. It seems like some of you were concerned about the formats of the discussion posts, and some of you asked whether the template I written by myself in week 1 of discussion should be the only format you're following for your reflection question. The answer is no. I don't really require any format about the reflection question as long as you have thoughts, you have some reflections about course contents. It's not a direct copy paste from the textbook. You can either do bullet points, reflection, essays, whatever you want, as long as you submit your reflections. And you can even post a video and have the link over there. That suffices as well. My goal for the reflection questions is for you to have a key takeaway from each chapter so that by the end of the course, when people ask you, okay, what you learned from Finance 3000, you can tell them that, okay, there were 3 parts of Finance 3000, Intro to Finance class. First of all, we talk about the general financial market and how to use the accounting information to measure corporate performances. And after the general introduction, we went into valuation. We talk about how to value any financial asset and specifically how to value bonds and stocks. And then we delved into the topic of risk. We connect the relationship between risk and return, and we learned how to incorporate different type of risk into calculating the discount rate when we are doing the valuation. And then when you recall the framework of Finance 3000, you have your takeaway under each chapter for yourself. Reflection questions really for yourself. In terms of grading, there's not much you can lose from the reflection questions. It's 1 point per week. If you submit it late, as long as you did it before the end of the semester, you still got 50% of the grades. Okay? Unless if I see there's just a one word or a direct copy paste from the textbook where there is automatically what is this thing, screening for any copy paste content from any online content. As long as that didn't happen, you will get at least 50% from each post, and it's very easy to get the perfect score. All right, that's the logistics. I highly encourage more of you to come to the office hour. We had a really great discussion with 3 of your classmates, and we can clarify a lot of concepts that you might find missing from your own studying and reading. And I really enjoyed the conversations. I encourage more of you to come so that I can get to know you better and we can have a conversation to compensate for the loss that we didn't. In chapter 4, we'll continue our discussion about accounting and finance. This week, we're going deeper into the financial statements and the accounting information we can get about a firm. And we're using this accounting information to compute some ratios so that we can further understand how well the financial managers has been doing their job, how much value they have created for the investors, and where does the value come from. There were a group of ratios we're going to discuss today, and the calculation is pretty simple. I want to emphasize before we start that the most important job for us in this week is to understand those ratios. You don't have to memorize it. You have access to the definitions from the textbook. The goal is to recognize what measure is measuring what value, from what perspective, and most importantly, what are the limitations from the ratios? What does the ratio tell us and what does the ratio does not? From chapter 1, we understand that the central goal of a financial manager in the corporate is to create value for the shareholders, making the pie bigger so that everyone with a ownership to the firm can get a bigger slice. And we know that financial manager can create value by either making really good investment decisions, which is the main value sources, and they can also create value or at least not to destroy value by making sound financing decisions. Okay, getting really good and cheap financing and don't have too much debt on your balance sheet. Don't get the firm too risky. And then underneath investment decision, how good an investment decision can be, we can further separate it into whether it is a really efficient use of asset or we're generating a high profit from our operations. On the other side of the chart, in financing decision, we can also separate good financing decisions by using a series of measures to measure how good a financing decision will be. Are they having sufficient liquidity for the firm? When they are due to pay debt, they have enough money to pay it? Or are they controlling their ratio of debt so that they don't introduce too much risk for bankruptcy? This chart summarizes the overall structure of this course content, and we're going to revisit this chart multiple times. Now let's start from the top. First of all, we need to answer the question how much value has been created on behalf of the shareholders. We have two accounting measures in combination of information from the market to judge how good a job a financial manager has been doing in terms of value creation. Those two ratios are first, market capitalization, second, market value added. They are basically the same measure, and one is the difference between two measures and the other is the ratio. Market capitalization takes the difference between the market value of equity and the book value of equity. What is the market value? The market value of equity is what the market think the firm is worth from the perspective of the shareholders. Well, when everyone think one share of stock worth $10 and there were 100 shares of the stock, so that we know jointly the market think the stock of this company is worth $1,000, which is the number of shares outstanding multiplied by the price per share. That is what we call market capitalization, and sometimes market cap. This is often the measure of the size of a public company. Market value added is simply the difference between market capitalization and the book value of equity. Okay, here this is the difference between the two measures. How much value we have created from the perspective of the market on top of the initial contribution from the investors. Let's take one example. We use Home Depot, which is a home improvement retailer, the largest home improvement retailer in the US actually. And we're going to be using Home Depot to continue as our example, as we have seen the balance sheet, income statement, and other financial statements from Home Depot in Chapter 3. Well, we want to see how much value has been created by Home Depot for the shareholders during the year of 2014. What information do we need? We know that market value added is the difference between book equity and market value of equity. So we need two pieces of information. The book equity is from the balance sheet. It's a book value. We go to the shareholders equity section from the balance sheet and we can directly read that total shareholders value for Home Depot during the year 2014 is $9,322 in terms of millions of dollars. Now we need the market value for Home Depot. We go to the market to find the market value. First of all, we search for the per share price from Home Depot. And this is one piece of public information. You go to any financial portal, type in the ticker for Home Depot, you get the timely price of this stock. It was $114.75 by the end of 2014. Right. And we also know how many shares are outstanding, meaning that how many shares can be traded on the financial market. We call this the trading volume, which was 1,307 million shares during that time. And then we multiply these two pieces of information together. How large is one piece of pie and how many slices are there to get how big is the whole pie, the market cap for Home Depot. And then we can calculate market value added by taking the book equity value away from the market equity value. We know that by the end of 2014, Home Depot's managers has created more than $140,000 million of value beyond the initial contribution by its equity shareholders, which was measured by the book value of equity. Well, the difference between the two measures also depends on how large Home Depot is as a firm. But what if we want to compare the relative performances of a big company with a smaller company? Naturally, the big company with the same amount of effort from its managers and maybe the same performances from the managers is going to end up with a higher market value added simply because it's bigger. Okay, market value is bigger, book equity is bigger, and the differences tend to be bigger. But what if we want to relatively compare? Per dollar of initial contribution from equity holders, how much additional value you have created for your equity holder, irrespective of, despite of the size of the company. That's where we use a ratio. The market to book ratio is the ratio between market value of equity to book value of equity. And for Home Depot, we have these two numbers. We find out that during the year 2014, the managers have created 16 times of the value on top of the contribution from the equity holder. So we can say that the managers have made the pie 16 times bigger than it was initially contributed from the equity holder. Okay, just the same target measuring values from two ways of measuring it. One is a difference and the other is a ratio. The ratio take away the effect of the size of the company. Okay, here we can list market value added and market to book ratios across a number of companies. This is by the year 2015 in terms of millions of dollars. Right, you can see that while Apple is the largest company in terms of both market value added and market to book ratio, sometimes market value added and market to book ratios can give different rankings, although they use the two pieces of the same information. Okay, this is mathematically true because when we take the difference of two numbers as compared to when we divide one number from the other, they can give us different results when we compare the results of different numbers. So the takeaway from this comparison is that when we are measuring the value created by a company, especially when we are comparing the value added across two companies, then using these two measure might give us different rank. And it would be prudent if we calculate both and see how it is different for different firms. We talk about the main source of value is from really good investment decisions. Now, how do we measure whether an investment decision is good or not? An investment decision is good when it is profitable, meaning that it can generate a high return for the investors, better than the other options the investors have. Now, let's look at one measure of the profitability of an investment decision. Note that here we talk about profitability in terms of how much profit has been created. And then we're going to break down profitability into whether it's from efficient use of asset or from profit margin. So profit margin is different from profitability. Okay, we're going to emphasize it again as we go to profit margin. Right, we have two types of measure for how profitable an investment decision is. First is EVA, economic value added, and the second is a group of rate of return measures. EVA is special in the sense that it does not only consider the amount of income generated by the firm over the year, the profit, the cash that has been made by operating decisions, by investment decisions. It also considers the cost of capital, meaning how much is the cost of getting the amount of capital we need to make those operations, to make those investment decisions. Recall in Chapter 3, we went through the income statement of a firm, and we know that the net income, the bottom line from the income statement, gives you an idea of how much money has been created, has been generated by the financial managers for the shareholders, the equity holders. Okay, and here we start EVA with after-tax operating income. And how is it different from net income? We know that for EVA, our goal is to find out what is the additional profit that was generated by the firm on top of the cost of capital. How much additional value, how much additional profit has been made by the firm? How much better the firm's investment decision is compared to the other opportunities the investors have for themselves. Okay, so there were two really important concepts from the calculation of EVA, which I find most students find confusing when we first talk about it. So let's take it slow here. First of all, what is cost of capital? Well, what is capital? Capital is the long-term money we need to invest in the firm. We need money to spend. And the people who contributed to our companies are investors, and the money they give us is called capital. So we have two types of capitals. One is debt, one is equity. And then what is the cost of capital? The cost of the capital is the return you have to pay back to your investor when they were giving you the capital in the first place. So what is the return we have to pay back our debt holders? Interest, right? Interest is a percentage of the initial amount of loan you are borrowing from your investors. Okay? The cost of debt is interest. And what is the cost of equity capital? The cost of equity capital is basically how much return the equity investor is requiring from the equity investment. Okay, and it's calculated by what is the other opportunities. For example, if I am a potential investor in Apple Computer, and how do I calculate my required rate of return from giving money to Apple Computer as equity holder? I find another company which has very similar risk and very similar operating profiles. It's comparable to Apple Computer, for example, Microsoft. Right? I see how much return I can get contributing my money to Microsoft. The return can take form in either dividend or capital appreciation, meaning the rise in stock price when I'm ready to sell the stock. Okay? And then I compute what is my required cost, what is my opportunity cost of capital, meaning that if I give up other opportunities to invest in Apple Computer, how much return I'm giving up. So that's return is my opportunity cost is what I'm requiring on my current investment. Right? So we have both cost of debt and cost of equity. And then because the capital is a mix between debt and equity, as a firm, we need to calculate what is the weighted average cost of capital. It's very similar to calculating your GPA. I got an A from accounting, A minus from finance, and then I take a weighted average between the total credits, the proportion of credits that taken up in my whole credit sources, and I see what is my GPA, the weighted average of my grades. So the cost of capital is basically the percentage cost of capital is the weighted average cost of equity capital and cost of debt capital. Okay, and then once we have the percentage cost of capital, which is often called the WACC, the weighted average cost of capital, we use this to time the amount of total capitalization, the sum between debt and equity. And then we get the total cost of capital in terms of dollars. Right? And this is the money amount of compensation we need to pay back all of our investors, debt and equity, as a compensation for their contribution of capital. Okay? And then after tax operating income, we are trying to measure how much profit the company has generated, how much cash the company has generated from their operations before we subtract the cost of capital to see how much in addition is left. Well, why do we use after-tax operating income instead of net income? First of all, because we are calculating the cost of capital from both the equity investor and the debt investor. So this income should be both money created for debt investors and equity investors. While we know that net income is only going to the equity investors, we need to add back the compensation we already given to the debt holders. Right? And we know that interest is the compensation we give to the debt holders. So we add interest back into net income. Then why are we adding back after-tax interest? Well, remember that paying interest saves your tax. In Chapter 3, the last part, we talk about interest tax shield. If you want, you can go back, open up the slides from Chapter 3, and go back to, I think this is the last few slides. There's an example about interest tax shield. Make sure that you understand what is an interest tax shield. Specifically, for every dollar of interest expenses you pay your debt holders, you're saving the fraction equal to the tax rate. Because interest expenses is tax deductible. It's reducing your tax liability. So that we didn't actually pay the interest expenses. We paid less than that. We paid 1 minus tax rate multiply interest expenses. This amount is actually what we pay. Okay? This is the amount we actually paid out as interest expenses because we save on tax. Okay, so we need to add back the actual outflow as interest expenses to net income to get the after-tax operating income as the firm's operating income after paying tax to the government. So the firm made operations and they made a bunch of money, they paid the tax, and then whatever they have left is what they have made for the investors, debt and equity. And we want to see how much in addition they have made on top of what is required from the investors. So we subtract cost of capital from after-tax operating income to get EVA, the economic value added. What is the extra money, the additional income the firm has generated on behalf of the investors? Okay, again, let's take Home Depot as one example to get information about calculating their EVA. Okay, make sure you pause the video and check with the financial statement from Home Depot where to get each number and how to get the final results here. Okay, I'm not going to go over it in terms of time, but make sure you pause the video and do the practice yourself. Okay, yes, let's just refer back to the balance sheet and income statement for Home Depot so that you don't have to flip through previous slides. Besides EVA, we also have a bunch of ratios that we can use to measure the profitability, how much profits has been generated. We talk about the difference between MBA and the market book because the ratios can give us another perspective when we're measuring things other than the difference. So those ratios, they always take a flow measure. Income, operating income, after-tax operating income. Okay? So either net income or operating income after tax as a percentage of a snapshot number, which could be the long-term capital or the total asset or the shareholder's equity, depending on whose perspective you're taking. And the interpretation for all this ratio will be how much profit has been generated per dollar of contribution from the investors. If we're focusing on ROE, return on equity, we're taking the perspective of the equity holders only. So in the numerator, we're using the cash flow, the money, the income, or the profit going to the shareholders. And in the denominator, we're using shareholders' equity, shareholders' contribution in capital. But in ROC and ROA, we're taking the perspective of both the debt and the equity holders. So in the numerator, we have to use a measure for profitability to all investors, debt and equity. So we're always using the net income plus after-tax interest, which is the after-tax operating income. And in the denominator, we always use the total capitalization contributed by both the equity and the shareholders, both the equity holders and the debt holders. Okay? All right. Those are the calculation for ROC, ROA, and ROE for Home Depot. We can see that the definition for ROC is after-tax operating income, which is net income plus after-tax interest divided by total capitalization, which is the sum between equity and debt, long-term debt. Okay, and we plug in the number from Home Depot, we can get ROC to be 0.253. The interpretation will be for every dollar of total capitalization from the firm's investors, Home Depot has generated 25 cents, a little bit more than 25 cents for the investors. Per dollar of contribution, 25 cents of income, of profits. For ROA, the calculation is 0.17. So for every dollar of total assets, Home Depot has generated 17 cents for the investors. Return on equity 0.507. For every dollar of equity contributed by the equity holders up to 2014, Home Depot has generated a net income to the shareholders of 50 cents. So 50 cents for $1. These two are taking perspective of all of the investors, shareholders and debt holders. And ROE is only taking the perspective of the equity holders. Whenever you're looking at a ratio, you need to understand whose perspective we're taking it. Is this only the equity holder or all of the shareholders, all of the investors, both debt and share? Okay, this table lists a group of companies with different ratios. And okay, here we can calculate the EVA and the ROC for all of them. We have their after-tax interest plus income. This is after-tax operating income. We have cost of capital WACC. Okay, this is already calculated for us. And then we have total long-term capital, debt plus equity. So we can calculate EVA. First, calculate the dollar value of cost of capital by multiplying column 2 and column 3, and then we subtract this number from column 1. And we can also calculate return on capital, ROC, by using after-tax operating income and divide the long-term capital. Okay, this is how we calculate the EVA and the different profitability measures. Well, if you compare it with the MVA table, the market value added table, you can see that the firm who have created the most amount of economic value added is most likely the firm who has created the most market value added. Okay, because although the two ratios are different, the EVA is a purely accounting ratio and the MVA is kind of a market-based ratio. How much in addition the market is giving value to the firm on top of their accounting value. But accounting information is valuable. It's a valuable basis for the investor's opinion about how profitable the firm is going to be in the future. Okay, the past is always an indication of the future. We know that Apple Computer has been doing really well accounting-wise on book, and this is also affect our confidence in how well Apple Computer is going to do in the future. Okay, and it's very likely that the firm has been doing well in the past. It's going to be the firm that is going to do well in the future. And that is going to be captured by the financial market to give you a higher market value. But it's not always the case. Some firm might be suffering on book, especially during a bad year. But if the market think the firm is going to recover really soon, or there is going to be a new trend in future, a new technology, And the market just have faith in the firm, although they're suffering accountingly. And then that's where we're going to see a low accounting value and a high market book value, market value. Okay, I encourage you to compare those two tables and see which firm is actually having a discrepancy in terms of accounting value created and market value added. Okay, now we are ready to delve into the sources of profitability. There are two types of sources from profitability. We can either generate profit by highly efficient use of asset, or we can have a high profit margin. Let's see how it works.
Now, what is efficiency? Efficiency is how fast you're turning over your asset, how much sales you have realized per dollar of your assets. Okay, how fast you're flipping your assets, how efficiently you're generating sales with just $1 of asset. And it's measured with different turnover ratios. The first turnover ratio we're going to introduce is the asset turnover ratio. It's measured as sales per dollar of asset. Okay, and how much sales you have generated per dollar of assets. We can either use the total asset at the start of the year, or an average between the start of the year asset level and the end of the year asset level. The logic of our preference for the second measure over the first one will be that if you had a certain level of asset and then you add additional asset during the year, you are not only using your total asset level at the start of year to generate the sales you had over the year. Okay, you might have also used the new assets. So by focusing only on the total asset level at the start of the year, it will be an overvaluation of the asset turnover ratio. Okay, it's biased upwards. So it's more prudent if we use the average of the total asset levels. For Home Depot, we can see that the asset turnover ratio from either measure is about 2.05, 2.07. So we know that for every dollar of asset of Home Depot, the company has generated about $2 of sales. $1 of assets can generate $2 of sales. That's how efficiently they're using their asset during the year. And we can also focus on a specific type of asset to see how efficiently the company is using that type of asset. For example, we often focus on inventory. Inventory is the goods that we buy from our suppliers and we put it into the warehouse and it wait to be sold. So if we are running the firm very efficiently, we don't have to keep a large warehouse because it takes space, it takes rent, it takes people to manage. We can quickly turn over our inventory. Whenever there is a sales order, we can get new supplies and put it into a limited space, and then it just turns into sales very efficiently. That's what we mean inventory efficiency. The inventory turnover ratio measures how efficiently we're using the inventory. Okay, and in the numerator we use cost of goods sold. That is how much value of the inventory before it turned into sales. Note that in the previous calculation we used sales, and here we used cost of goods sold. Cost of goods sold is a cost basis for all the goods that you're going to turn into sales later. And the inventory level at the start of the year, where you can use the inventory level. No, here we only use the inventory level at the start of the year. So the inventory turnover ratio is cost of goods sold divided by the inventory at the start of the year. For Home Depot, this number is 4.9. So we know that for every dollar of inventory at the start of the year, $5 of them, 5 times of them, is turned into sales later. Right? And another more intuitive measure for inventory efficiency is the average days in inventory. It tells us how much inventory we have in the warehouse. How many days the inventory we have in the warehouse can last for sales. Okay, So for this, we use the total level of inventory at the start of the year divided by the per days sales. Okay, in the second part of the calculation, you can have this 365 to the denominator. So it's going to be cost of goods sold divided by 365. That's going to be the per days sales in terms of cost basis. And then you use the total inventory at the start of the year to divide the per days sales. You can see that how many days of sales can you last for the inventory that you had in the start of the year. In the case of Home Depot, we know that they have a certain level of inventory at the start of the year, and this inventory can last 74 days of sales. So that after the 74 days, they need new inventory to generate more sales. Okay, you can see that those two measures is kind of an inverse of each other. So the higher the inventory turnover ratio, the lower the average days in inventory. When we say that a company is managing their inventory very efficiently, they have a smaller warehouse and their inventory in the warehouse can last shorter days before they have to turn over the inventory, have to get new inventory to generate sales. Okay, that's what we mean that they're managing their inventory very efficiently. They're not piling up their inventories. They just sell whenever they get new supplies, whenever they need to generate new sales. Right, and then we can focus on receivable as the asset. From the balance sheet, we can see receivable is a short-term asset. It's a current asset for the firm. And the receivable is generated whenever sales is generated, but the payment is not collected. Okay, and it's basically you're giving out short-term loan for your customers. You can have them get the goods first and before they pay you. We know a lot of companies actually offer these services to the consumers. For example, you can buy something on credit. That's a form of receivable. Well, if we're having too much receivable as a firm, that means a lot of them might turn into bad debt. We already provided the goods and services, but the customers may not pay us back, which is not a good thing. Okay, so we don't want too high a level of receivables on the balance sheet. And receivable turnover ratio managed, but we do want some receivable because we want the customers who cannot afford to pay the full price today be able to still buy this good and services from us, and we can generate sales. So the receivable turnover ratio measures how efficiently we're using receivables to generate sales. It is the sales per dollar of your receivables at the start of the year. Okay, we have this amount of receivables for Home Depot and this amount of sales during the year. We can see that for every dollar of receivables at the start of the year, $59 of sales was generated. We don't know how big or how small this number is. We have to compare it with other firms, which is similar to Home Depot, and we have to compare the change of the ratio for Home Depot across time, which is how we judge whether a number is reasonable or not for all accounting ratios. Similar logic with the inventory turnover ratio and average days in inventory, we can compute another more intuitive ratio for receivable turnover, which is the average collection period. It measures the average number of days for the firm to collect payment, to cancel the account receivable. How many days is between when the goods and services is provided and the payment is collected? To calculate this ratio, we use receivables at the start of the year to divide the average daily sales, which is your total sales over the year divided by the number of years in number of days in the year. For Home Depot, the average collection period is about 6 days. Okay, again, we have to compare it with similar firms and across time. Okay, the DuPont system. What is the DuPont system? Well, it's a system created by an accountant from this DuPont company, this pharmaceutical company. I think the accountant from the company, they just stare at the ROA calculation long enough, and they figured out a way to separate this ratio into two parts, and each part have an economic meaning. If you look at the ROA calculation, ROA equals to after-tax operating income divided by assets. How much total income you have generated for your investors per dollar of their contribution to your assets. This is a measure for overall profitability. And if you add sales in the numerator, and again cancel it by adding sales in the denominator at the same time, it doesn't change this equation, right? Mathematically, we cancel sales here, cancel it here, it's go back to the original formula. But if we do this maneuver, we can see that each part of the equation now have a new definition. Now, we know sales divided by asset is what we just went over, the asset turnover, right? How much sales you have generated per dollar of asset, how efficiently you were using the assets. And the second part is after-tax operating income divided by sales, which is our operating profit margin. Okay, and what is the profit margin? The profit margin is how many per dollar of sales, how much of them is turned into profit. From the income statement, we go from sales, which is the top line, we subtract all the expenses, the cost of goods sold, the SG&A, the depreciation, and we end up to a tax to the government, and we end up with the net profit we're making. So profit margin is the proportion of profit from each dollar of sales. And now we have separated this two parts, this profitability, into two sources, exactly like what we showed in the chart from the beginning of class. Right? Now we have two sources of profitability. From DuPont system, we understand why we are able to break up the profitability measure of an investment decision into efficiency and profit margin. Right? ROA is a measure for investment profitability, and the asset turnover ratio is a measure for efficiency, and the operating profit margin is the measure for profitability margins. Okay, let's do the practice for Home Depot. We can find the ROA of Home Depot during the year 2014 by using their financial statement data. Got the tax operating income from calculation in the net income in the income statements, asset level at the start of 2014, which is also the end of 2013, to find the ROA. They have a 17% ROA, which is pretty high to the average, because most typically all the firms in the US have a ROA ranging mostly from 3% to 10%. So 70% is pretty high for that year. Further breakdown of the profit drivers, we can see that the operating profit margin for Home Depot during that year is 8.3%, and the asset turnover is about two times. And using the two numbers multiplied together, we get the same ROA number as before. Right. And then what do we know? What is the main driver of the high profitability Home Depot has enjoyed in 2014? Well, just by looking at the number, we don't know either. Like I said, all numbers need to be put into perspective in terms of the change across time, time seriously, and then how does it compare to other peers during the same time cross-sectionally. If we put the number into context and see all firms operating in different industries, this is the year ending in 2015, and we have grouped firms into 45 industries. We can see that the profitability measures, the operating profit margin, and the asset turnover. So the blue line represents all the ROA, which equals to 3%. Okay, and to achieve a 3% ROA, you can have different combination between operating profit margin and asset turnover. right? And this is a line. The red line represents all the ROA of 10%. Again, you can have a really high asset turnover like the food stores, or you can have a high operating profit margin like computer peripherals. Well, why is it not always possible, well, not often seen for a firm to have both high profit margin and high operating efficiency? Well, if we think about that, if we want to have a high margin by selling our goods, what do? We charge a high price. We have a low cost of getting the supplies, but we want a high margin, we charge a higher premium. That necessarily means that our price is going to be high. What happens when our price for our goods is high compared to the value? People are less likely to buy it. When people don't buy it, our sales reduce. So goes our operational efficiency. We have lower number of sales per dollar of our assets. So the turnover ratio is lower when we have a high profit margin. But if we want to achieve a high sales number to have a high operating efficiency, asset turnover ratio, well, in order to have a high sales, we must be competitive in the market by having a low price. A low price hurt our profit margin, given the cost that we need to generate these goods and services. So it's very hard for one company to achieve both. And oftentimes, whether you're a high margin firm or a high turnover firm is determined by the nature of the business. Okay? If we look at, yes, as we go lower, we're going to see that, okay, for firms that have a high asset turnover ratio, for example, retail trades and motor vehicles, they also have a pretty high asset turnover ratio because cars is turnover faster than houses and pharmaceuticals, machineries. See, and they tend to have a relative low profit margin, right? And for industries which enjoy a high profit margin, for example, publishing, chemicals, and pharmaceuticals, they necessarily have a low asset turnover ratio. Because you need a lot of assets, a lot of inputs to get the infrastructure in place to generate the goods and services from those industries. And those industries also happen to be the ones with higher debt ratio, higher leverage ratio. Also because of the heavy capital requirement to generate sales. Okay, let's go back. So it's very hard to get both high turnover ratios and high profitability, high profit margins. And that is also why, by looking at the DuPont system, by breaking the ROA ratio into two parts, we have a better idea of what is the profitability drivers of the firm and what is the strategy of the firm. Right, now we are ready to discuss the last group of ratios, which is financing ratios. We want to see how good a financing decision the financial manager has been making. Are they having the optimal mix between debt and equity? Are they having too much debt? Are they putting the firm very close to bankruptcy? Or are they not using sufficient debt to capitalize on the tax benefits of debt? Do they have sufficient money to pay back debt as they were due? And how safe are we? Basically, how safe are we from bankruptcy? Okay, let's delve in. The first group of ratios are the financial leverage ratios. The target of this group of ratio is just to find out how much debt the firm have indeed. Financial leverage is the portion of debt in the capital structure. Well, why do we call the mix of debt leverage? This is taking the perspective from the equity investor. We know that how is debt different from equity? This is the topic we're going to delve in Chapter 7. Debt and equity at difference. The most fundamental difference between debt and equity is that debt is a fixed income financial asset, but it has priority in terms of payment. No matter how good and how bad the firm does, the debt holders always get paid back fixed interest and fixed principal value when the debt matures, when the debt is due to be repayment. If the firm makes more money, the debt holder doesn't get more. It all goes to the equity holder. If the firm doesn't make any money, the firm still have to pay back the debt holder no matter what, unless it goes into bankruptcy protection, so that it doesn't have to pay the debt that they cannot pay. Because a corporation is protected by limited liability, their owners don't have to contribute their own asset. But it's different for a sole proprietorship or a partnership where the owners have to contribute their own asset to pay their debt holder. But the equity holder is different. When the firm does well, every share of the firm in terms of equity value goes up. The sky is the limit. But when the firm doesn't make any money, the firm have to pay back the debt holder first before they have anything left to pay back to the equity holder. So from the perspective of the equity holder, the debt holders are their lever to higher profitability. The more debt they have, they can have more initial capital to realize more potential growth, but this debt holder does not participate in the growth. They get fixed money, then that's it. But having a higher amount of debt also raises the downside risk for the equity holder, because the firms still have to pay off all their debt holders in terms of interest and the debt due before they can distribute any income to the equity holder. So financial leverage is what the equity holders see the debt in the company. It's a lever. It exaggerates everything, the gains and the losses. Okay? And from the perspective of the equity holder, we know that the higher level of debt, the higher risk, because there's higher likelihood that the firm is going to fall behind debt payment and declare bankruptcy. Well, the firm have to go into bankruptcy. We mentioned bankruptcy in Chapter 1. Whenever the firm cannot pay back their debt as due, interest and debt repayment, they have to declare bankruptcy. And when there's bankruptcy, there's no tomorrow, there's no upside, there's no future. And the equity value of the firm goes to zero when there's bankruptcy. So the equity holder really don't want bankruptcy. And they want to watch the amount of debt in the capital mix of the company to make sure that it's not too much. Okay? And as in Chapter 6, we're going to see that the amount of debt in the firm's capital mix also determines the ratings for the company, the creditworthiness of the company. Okay? It's all related to risk, as we're going to focus on risk in Chapter 11 and Chapter 12. Here, we just need to know that this leverage ratio is all trying to understand how much debt you have. We have multiple times. The long-term debt ratio uses the long-term debt divided by long-term debt plus equity, which is your long-term capital. We ignore short-term debt because it's going to be paid back within a year. And then we also have long-term debt to equity ratio, which take the percentage of debt compared to equity. Just how many times of debt you have as compared to your equity. Make sure you know what's the different definition, the different formulas for the different ratios. And total debt ratios is a ratio between total liabilities and total debt, total asset. And then we have two other ratios, which focus on interest payments. They want to understand, do you have sufficient income to pay back interest? And the time interest earned is EBIT and divided by the interest payments within the year. It answers the question of how many times operating income can cover interest payments due. The higher the number, the safer we are, because we are very safe. We have sufficient income to pay back all interest. Cash coverage ratio. Well, it basically, the only difference between time interest earned and cash coverage ratio is that in the numerator, you add back depreciation, because depreciation is a non-cash expense. It's already deducted from EBIT, but it's not a cash. It does not reduce your payment ability. When you really have interest payment due to pay, you can also pay. You can pay using the depreciation money because it's not really a cash outflow. So you add back depreciation. You usually end up with a higher ratio than times interest earned, but they're very similar. They're measuring the same thing. Now, liquidity. What is liquidity? Liquidity belonging also to the group of financial ratios because we want to know that when the firm is really in need of cash, most oftenly that happens when the firm have debt to be repaid. How quickly, if they don't have cash in their account, in their savings account, how quickly can they convert their assets into cash and pay back whatever need to be paid? That's also a safety net. That also measures how far away are we from bankruptcy. Okay, liquidity is how fast and how easy we can convert assets into cash. We mentioned it in chapter 2, and again, we're going to mention it multiple times in chapter 7. Liquidity in the stock market measures how fast you can sell a stock. In the financial market, it means how fast you can sell your financial assets. Basically, it just means how fast you can sell your asset. Depending on which market you are in, the definition might be slightly different. Okay? The first concept we want to introduce is a net working capital. We know that on the balance sheet, the two sides of the balance sheet all list the most liquid asset or liabilities in the top. So current assets are the assets we consider to be more liquid than long-term assets. They can be more easily converted into cash. Net working capital is the difference between current asset and current liabilities. Current liabilities is what we have to be repaid within a year. If we use our liquid asset and subtract all the immediately due liabilities, we have a net working capital which can be considered the cash reservoir in our company. What we have left if we pay back immediately due liabilities and convert what we can convert into cash quickly. And the net working capital to total asset ratio basically take the percentage of net working capital per dollar of total assets. Current ratio is the amount of current asset per dollar of current liabilities. Another way to compare how many liquid assets do you have when you have to pay back all your immediately due liabilities. And as we go stricter and stricter in the definition for current asset. Okay, in current asset, we know we have cash and equivalents, or cash and marketable securities. We have inventories, we have receivables, and other current assets. But what if we think inventories are not very liquid? Because inventories have to be converted into cash, somebody have to buy the inventory. We don't think it's liquid enough, so we take it out. And then in quick ratio, we have all the current assets but inventory. Cash plus marketable securities or cash equivalents plus receivables as a percentage of current assets, current liabilities. And in cash ratio, we don't think receivables are liquid enough because we have to collect receivables. What if our customers just won't pay us? Then we subtract receivables from the denominator, only focusing on the most liquid asset of all, which is cash. Right? The cash ratio divide cash plus marketable securities by the current liabilities. Now we have gone through all the most often used financial ratios based on accounting information we have from the financial statements and also from the price information of the market. And we can compute this for any firm, any public firm with financial statements. We log into SEC Edgar and we find their financial statements, we put it into the spreadsheet and we compute the ratios. When we get the ratios, now what? How do we interpret the ratios? Some of the ratios, the higher the better for sure. For example, the market value added is always the better, the higher the better. Right? That means we have created more value as a firm. The pie has grown into a bigger pie. But the other ratios we don't really know. For example, how much is a good leverage ratio? How much debt is optimal? We don't want it to be too high because of bankruptcy, and we also want some debts in the mix because of the tax benefit and also the leverage effect. Liquidity measure. Do we want a really high liquidity measure? Well, would that mean we have cash left on the table? We're not operating our firms tight enough. We're not using the dollars efficiently. What are the efficiency measures? What is the strategy? What is the optimal strategy? We don't really know. Then how do we know? We have to put the ratios into perspective. First of all, we compare the same firm's change of financial ratios over time. For example, Home Depot's ROA has endured its up and down through time and has a big dip during the financial crisis for sure, and then it steadily has been recovering since then. Okay, so we know that Home Depot is doing pretty well compared to like 10 years ago. And then we can have a breakdown between the source of profitability for Home Depot. We can see that operating profit margin is rising and the turnover ratio is also rising. So they are both contributing to the higher ROA for Home Depot. Okay? And they have been recovering. Besides comparing the firm with the firm before, we also need to compare the firm to other firms which operate very similarly. For example, for Home Depot, a very good comparable will be Lowe's. They always open next door to each other, and of course, they're competitors. Very straightforward. If we compute the same set of ratio for the two firms and list them side by side, it can give us some insight about relatively how good Home Depot has been performing financially. We can see that Home Depot is apparently more profitable company with a higher value creation. Okay, the market value added and market to book ratios are much higher than Lowe's, and they're also bigger, more profitable. You can see profitability measures, all of the return on asset, capital, and equity ratios shows a much bigger number for Home Depot. It's just Home Depot is more profitable than Lowe's. EVA is higher as well, created more income as on top of the cost of capital than Lowe's. And if we compare the leverage ratio, we can see that they're about quite similar in terms of leverage ratio, and Home Depot might have more debt, slightly more debt. Okay, but they are safe in paying back their interest because they generate a lot of income to pay back the interest. Liquidity measure, and they have more net income, net working capital, so more cash reservoir. Their current ratio, quick ratio, and cash ratio are all higher. So they have more liquidity. And when we focus on the efficiency ratio, we can see that the asset turnover ratio is comparable. Home Depot is slightly higher, and but when the inventory turnover ratio, days in inventory is comparable, profit margin is higher, operating profit margin is also higher. But when we focus on the receivable turnover and average collection period, which is basically the same ratio, we can see that Lowe's have a much higher receivable turnover. And we might tend to think that Lowe's is using their receivables very efficiently by collecting money from their customers quickly, but which may or may not be a good thing. That we have to debate. Okay, whether it's generating enough revenues for them by having a strict credit policy to their customers. That's debatable in the first place. But when we get behind this number, when we find out what actually happened, we find out that this high receivable turnover is not because of operation, but because of a corporate financing policy that Lowe's tend to sell off their receivables as an asset to other firms. They're writing off this amount of asset on their balance sheet. That's why they keep a lower amount of receivable on their balance sheet so that their denominator is smaller, the ratio is going to be higher. It's not because of operation. Okay? So again, we want to emphasize that the accounting ratios provide a wealth of information, But oftentimes, that is our first step in the financial analysis process. It really does raises more questions than it answers. We couldn't take the numbers at face value because numbers can be created multiple ways. Okay? And besides the fact that the numbers might not be true because of accounting malpractice, apparently, right? During chapter 3, we talk about multiple ways of accounting malpractices. And if we put that into the perspective of the industry, we can see that a lot of the ratios is determined by the nature of the industry. The business model, the competition landscape, whether it's protected, and there's any regulations, and etc. And the final goal from chapter 3 and chapter 4, why do we care about accounting numbers? Why do we play with accounting numbers to create those financial ratios? Because as investors, we don't operate the firm. We're not involved in the daily decision making as a financial manager do. But our money is contributed to the firm. So we want transparency. We want to know exactly what is going on, how healthy the firm is, and what is the value of our financial asset, which is tied to the performance of the company. Transparency is what the accounting information provided to us, and that's what we're trying to find out using the accounting information. Right, that's the summary from chapter 4, and we basically talk about how to measure corporate performances by different financial ratios used from the accounting information and information from the market. Starting from the top to the bottom, how much total value has been created, and whether it's from good investment decision or good financing decision. If the investment decision has been profitable, is it from an efficient use of asset or is from high profit margins? For financing policy, we want to know how much debt is in the capital mix, and do they have enough money to pay back the debt as they do. Okay, chapter 4 also concludes the first part of our class. I will be making your quiz today, so that by the end of the week, I will post the quiz, make it available, so that you're ready to do the quiz, which is a review for the first 4 chapters. Okay? And in the syllabus, you can find out details about the quiz. Basically, it's a quiz. It's timed and it's graded. It's the first majority part of the first component of a big chunk of your grades. More details in the syllabus. Please go read the syllabus. And then after the quiz, we're going to go into the evaluation part of our course, which is arguably the most important part and the most heavily questioned part from the common final. All right, get your financial calculator ready by the end of this week, and then watch the video I posted under week 5 about how to set up your financial calculator. I'll see you next week.